Siddharth Sanyal of Barclays Capital. I want really a reaction, not just on the overall policy that I read out to you, but moreover, risks to inflation remain on the upside, both from domestic demand and higher global commodity prices. Vigilance needed on build-up of demand-side pressures. Are they literally telling you, Siddharth, that January you could expect a rate hike?
No, not really, Lata. In the sense, we all admit that slightly on the longer term, over the medium term perspective, India is facing significant inflationary pressures, no doubt about that. But if you see the headline numbers, to reach the market inflation expectation and the policymakers to react to a great extent, is more or less set to soften significantly from here on for the next 3-4 months. I would expect headline inflation to come very close to the 5.5% projection of the central bank by March or April.
Despite petrol prices and diesel prices being raised?
Yes, the diesel, not for the petrol price, the diesel price is a risk. The diesel price part can actually inflict some kind of 25 to 30 basis point direct impact on the headline numbers. But apart from that, the overall headline dynamics can be softer from here. So that is one part. And when they are holding back on the action front, they will be more vocal in terms of making their statements. So we are not factoring in any rise in the January policy.
All right, that's probably.
On the other hand, there is something very.
Yeah, go ahead.
One additional point here on the liquidity part. I think what they have done is extremely interesting. There is a very big difference in terms of power of liquidity when it comes from the central bank and when it's float around in the interbank market. When it comes from the central bank, the money multiplier comes into force in a much bigger way. That way, in the near term, when there is a bit of pressure, the central bank doing the Waymo and expanding their balance sheet, to me, is a very, very healthy sign. It was long overdue.
All right. Let me get one word from the stock markets. Anand Tandon has been with us for quite some time now. Anand, thanks for waiting patiently. What's your sense? Exactly as you said, looks like gilts are getting a further leg up from the announcements made. Would you say that now the writing is clear on the wall that markets should be prepared for a higher interest rate scenario?
I think so. I think irrespective of whether the policy rates will go up, like the other panelists have been saying, there is an upward pressure on interest rates, and very broadly that's not necessarily very good for the equity markets, or for that matter for any asset class. The interesting bit is that, as they mentioned, that the deposits are lagging behind, and if you see that they are not getting into equity markets, the question is, where is the money going? It would appear therefore that the things like real estate are probably taking up a large part of the money coming through. And that is something that perhaps will result in some asset inflation even further, probably already has, and I think the policymakers need to take a further look at that.
All right. Anand, thank you very much for joining us. Dr. Chaudhary, to you, sir. You heard all the key words in the policy. What's your own sense? The Reserve Bank will be preparing for a lot of demand-led inflation, asset price inflation. How do you see the interest rate policy environment in 2011?
Give it a fixed handle on demand side pressures. It doesn't give it a handle on supply side pressures. So that they have underscored the importance of having vigilance on demand side pressures is appropriate and correct, because that is on the edge that it can work on. We are growing at almost 8.9% in the first half, maybe 8.9% in the second half, who knows. But at this pace, clearly, demand side pressure will be strong, and we know that we have a lot of supply side deficiencies for a variety of reasons, so there will be frictional inflation, and this basically underscoring the need for that. Secondly, international conditions are quite unsettled, and when international conditions are unsettled, then you have to take that into consideration to try and reduce risk. And when you try to reduce risk, what do? You actually keep a monetary policy tight. So I think not only because of inflation, but even on account of other factors, you have to maintain a tight ship, both on monetary side as well as on fiscal side.
Right. Dr. I'll come back to you with this SLR cut announcement. Amitabh Mohanty of Reliance Capital Asset Management. Amitabh, very clearly a good day for FMPs and gilt funds is around the corner?
See, FMPs have been getting a lot of flows in the recent past. I think the rates are very attractive, that you can take just CDs and build a portfolio which is delivering 9 quarter kind of a portfolio. So that is really doing well. What RBI has really done is take a lot of uncertainty out of the liquidity situation. I don't think anyone was expecting that it goes into a surplus kind of a mode, but by announcing a calendar for OMO, by actually structurally reducing the SLR by 1%, I think they have sent a very strong message to the market that liquidity is on the top of their mind, and they are going to aggressively target that. And the point that I would like to make is we seem to have forgotten the FIA auction on gilts, so that we are expecting to start flowing in sometime in Jan, which will again start giving a lot of support to the gilt markets. So overall we are saying that yes, no one expected a very benign inflation kind of a situation. No one expected RBI to go out and say that okay, we have passed all our troubles, but I think what the markets wanted from this policy, aggressive liquidity, addressing steps, they have delivered on, and I think that will give a lot of comfort to the market.
Oh, it indeed is. Already we are seeing bond prices rising significantly. Okay. Well, now I want to shift to a slightly macro issue with the two economists, but running out of time. Very quickly, Siddharth, it is a very good message and strong message to the fisc itself. I mean, we are going to get 1% less of the total deposits. You know, this is a message to the fisc that you better reduce the total fiscal burden, you would say?
Yes, absolutely. If you see from a longer term point of view, this is a clear message for them to tighten their belts. But having said that, possibly next year still you are going to see some kind of elevated borrowing number. Even if the headline GFD by GDP number softens, the actual magnitude of gross borrowing can be pretty significant. In that case, on the longer term bonds, in the medium term, in FY12, it can generate a bit of pressure.
Okay, I'll come to Hemant again on this issue, but Dr. Chaudhary, your take, sir. I mean, this was needed, you would think. In fact, if this policy will be remembered for anything, it will be for this longer term reform of 1% cut in SLR. What would be your comments?
Well, you know, originally the RBI Act fixed it at 25%. The Act was modified some years back.
Yeah.
So it's been given effect to now. I think this is a welcome move. The second thing is that the 48,000 crore OMO, I think, is an appropriate response to the liquidity conditions obtaining in the market. I think it also gives the signal that RBI perhaps in future too will use the OMO route to release the LAF window when it becomes too heavily burdened.
I wanted your comment on whether it is a good message to the fisc.
Okay, I think RBI makes that message, the fisc tells itself too, and the government is committed to a certain fiscal path, so I wouldn't make too much of that.
Okay.